Welcome to our weekly market summary for the week ending 6th of November. Coming at you live this time from sunny Uringa in northern New South Wales. Now, there's probably a few distractions, but hopefully we'll get away with it. So finally, we have an election result in the US, and there was little doubt that it was the preferred result for markets. The prospect of a hobbled version of Bidenomics, where there is an upward bias to future fiscal stimulus, but with the restraint the Republican Senate implies, has been met warmly by markets. The icing on this market cake is also the likely reduction in the inherent uncertainty that Trump has brought to geopolitics and trade, for now at least. So if we can have roughly the same conditions without that, probably a net positive. That meant that markets around the world were up by between 5 and 10%, making up for the falls of the week before and some more besides. Interestingly, the biggest beneficiaries were US tech stocks and Europe at the same time, something which neatly points to the polarized state of markets and the investment opportunities that may lie ahead. So Europe represents beaten down value and is a staple for value managers, while US tech is the driver of global earnings growth and a mainstay of growth portfolios. A more fiscally stimulative US points to a recovery trade of sorts that will benefit value stocks, while lower interest rates and a less obviously aggressive antitrust environment offers a brighter outlook immediately for large tech, certainly than a blue wave might have done. The likelihood of lower interest rates and continued absence of the bond vigilantes also helps both camps, but it's especially the latter. Most other sectors in the US globally were also up by around 6%, while energy stocks and utilities were up, but markedly less so. At a sector level, things in Australia were a little bit more interesting. One of the main things that affected the local market was the announcement by the RBA on Tuesday that they were cutting short-term rates to 0.1%. But even more so that they would be actively buying government bonds in the secondary market in order to suppress long-term rates and on a routine basis, so-called quantitative easing. This was widely anticipated. We even mentioned it last week, so it was surprising that bond yields gapped down on the news. However, that didn't last long, and the next day the US election news cycle took over again and our bond market synced right back in with US yields. Be interesting to see if that incredibly close relationship continues to hold now that the election has been decided. It's quite usual for our bond market to move in sync, but for the absolute levels to be exactly the same over a sustained period of time, that's a little bit more unusual. So we'll see what happens there. That might diverge a little bit over the next few weeks. Now, the impact on local bank shares was, however, seen as positive, and it did stick. It's positive indirectly as it probably will settle the property market and the economy, but it also has some direct benefits for bank funding. The fact that the banking sector was up by 10% last week accounted for 2.5% of the local market's overall rise of 6.5%. Which was sort of reasonably high, but it was at the sort of bottom end along with other Asian markets. So without that, a relatively weak performance by the local market would have been more evident, and the impact of China's prospective trade restrictions on our exports perhaps more obvious. Well, at least the ones that they are not dependent on, such as iron ore. Elsewhere around the world, long-term bond rates also dipped amid fears of a contested election earlier in the week, but ended the week following the US hire, as we got that sense that it was going to be a Biden win and a Republican Senate. In that context, commodity markets were noisy, but most markets still ended up in positive territory, including both gold and oil. So now we've got that week out of the way, what are we going to be looking at in the week ahead? Well, still the US election to some extent. So far, Trump and his followers seem to have been relatively subdued, relative to expectations at least. But this could still be the calm before the storm, so maybe still worth keeping an eye on if there's any appetite left for news consumption. So we will be updating our valuation dashboard. Now normally we update this in the weeks after each quarter end, absent significant market events or moves, but for obvious reasons we've held so far this quarter. We've been discussing and modelling out some very divergent scenarios and had planned to write a, modestly of course, epoch-defining bit of scenario analysis. Well, we're somewhat happy to report that the valuation dashboard update we publish next week will now be a little bit more mundane than it might have been otherwise, and we will contemplate a somewhat narrower range of possibilities. Now we suspect we're not alone in this, and that is really why markets were up so much over the week. but there'll still be some long-term thinking going on. We probably still, we think, are in the midst of a regime change, and the long-term navel-gazing will have to continue to some extent. So with that in mind, we'll leave you with an interesting interview with Neil Howe that was published yesterday. He wrote an interesting book called The Fourth Turning in the late 1990s, which has turned out to be eerily prescient. Now, his framework for analysing the impact of generational shifts in demography can be too prescriptive for some, but this article is thought-provoking and does put the events of last week into an interesting context. So I'll add that to a link to that in the podcast notes if you're listening to it. With that, thank you very much. Hope you have a good week, and we'll talk again next week.